The payments industry moves fast. The economics behind it move even faster. Welcome to On the Wire, a show about the economics of payments, the institutions moving money, and the infrastructure underneath it all. This episode is produced by Payware using AI voice synthesis, built from primary research, technical documentation, and real market data. No studio, no hosts, just the content, clearly presented. Let's get into it.
Every time you tap your phone or your card to buy, a $5 coffee, you actually trigger this microscopic 12-step relay race that basically spans the globe.
Right. It's a huge hidden process.
Yeah, and it involves 4 different corporate middlemen. It takes up to 3 days to actually finish. And someone, usually that local coffee shop you're at, has to pay a toll to every single one of those middlemen just to make the register beep.
It is honestly a brilliantly constructed illusion.
It really is.
I mean, we are so conditioned by the convenience of that immediate little chime at the register that we just assume the digital money magically teleported straight from our bank account into the barista's cash drawer.
But the reality of the infrastructure is far messier.
Oh, absolutely.
Welcome to this custom deep dive. Today, we are bringing out the crowbar and tearing up the floorboards to really look at the invisible financial plumbing underneath your everyday purchases. We are exploring a comprehensive technical and business guide from Payware, all about account-to-account, or A2A, payments.
And our mission for this deep dive is to unpack exactly how these A2A payments actually work under the hood.
Right.
We're going to examine why the legacy card-based system we all currently use is surprisingly bloated, and how this new technological third option is leveraging modern banking infrastructure to save businesses millions.
While fundamentally changing how you will actually check out in the near future.
Exactly.
So whether you are running a business and you are desperate to stop losing your margins to hidden fees, or you're simply a curious consumer wondering why the global economy still runs on plastic rectangles, this dive is going to completely change how you view a simple tap at the checkout counter.
It really reframes the whole experience.
Okay, so let's unpack this, starting with the baseline. If money isn't teleporting when I tap my phone, what is actually happening in that 12-step relay race?
Right, so let's follow the data. When you tap your card, the terminal reads your information and hands it off to a payment gateway.
Okay.
The gateway then encrypts the data and forwards it to a payment processor.
Got it.
And then the processor routes that request to the card network. So this is your Visa or MasterCard, right?
Right, the big ones.
Exactly. And the network then finally forwards the request to your issuing bank, which checks your balance, runs its fraud algorithms, and generates an authorization.
Okay, wait, I need an analogy here because that sounds like way too many cooks in the kitchen.
It is a lot of cooks.
So it's kind of like taking a local taxi ride, but you're forced to route through 3 different dispatchers, a toll booth, and a multi-day holding pen.
Yes.
And you have to pay a percentage of your total net worth to each of them just for the ride. So the payment gateway is essentially the bouncer at the club checking the ID.
Right.
The processor is the armored car transporting the requests safely. The card network is the private toll highway that the armored car drives on, and the issuing bank is the actual vault that holds the money.
That is a perfect way to visualize it. But here is the catch. That long journey down the toll highway, that is just the request going in one direction.
Oh, right, it has to come back.
Exactly. The bank's authorization, which is literally just a simple, yes, they have $5, now has to travel all the way back through that exact same chain.
Unbelievable.
Bank, back to the network, back to the processor, back to the gateway, and finally back to the terminal so it can beep.
And here is a fact from the Payware guide that absolutely blew my mind when I read it. All of that data bouncing around the globe through all those checkpoints, and no actual money has moved yet.
Not a single cent.
Wow.
The merchant just received a digital promise of payment. At the end of the day, all those individual promises are batched together.
Right.
And only then does the actual settlement process begin, where funds finally move from your bank to the merchant's acquiring bank. And that settlement, it takes 2 to 3 business days to clear.
It's like the legacy system is built on the concept of mailing a physical letter. You drop it at the local post office, the gateway, it goes to a regional sorting facility, it gets put on a specific airline, which is the network, and it takes days to actually arrive.
The postal analogy works beautifully because every single touch point in that journey requires funding. The card networks and the issuing banks don't maintain those massive highways for free.
No, of course not.
For a standard, say, €100 transaction in Europe, the issuing bank takes an interchange fee, the network takes an assessment fee, the processor takes a cut, and the acquiring bank adds a markup.
So if I'm a small business owner selling €100 worth of goods, what does that multi-day postal journey actually cost me at the end of the day?
You are paying anywhere from 80 cents to €2.50.
Oh, wow.
Yeah, that's 1 to 2.5% of your total revenue gone just for the privilege of moving digital zeros and ones from one ledger to another.
That feels incredibly steep for just moving digital data. Why is it so high? Does the computing power to route that data actually cost that much?
Oh, not at all. The underlying computing cost is fractions of a penny.
Right.
Yeah. The card networks charge percentage-based fees simply because they have decades of entrenched network effects. They built the initial roads back in the 70s and 80s, so, they could dictate the tolls today.
Because they're the only roads in town.
Exactly. But the monopoly is exactly what the account-to-account, or A2A model, is designed to bypass.
Enter the A2A express lane. If the card network is mailing a letter through 4 different sorting facilities, A2A feels like making a direct FaceTime call. You are bypassing the middlemen entirely. But how does that actually work under the hood?
So it collapses that bloated 12-step process into a direct 5-step flow.
Just 5 steps.
Right. The customer initiates the payment, their bank instantly authenticates them, the payment is authorized, the money moves directly from the customer's bank to the merchant's bank, and both parties get instant settlement confirmation.
So the gateway, the processor, and the card network they're entirely removed from the equation.
Completely gone.
Let's focus on that middle step for a second, the banks talking directly to each other, because I saw the term ISO 2022 heavily featured in the payware guide. What does that actually mean for the financial plumbing? Because, historically, banks were notoriously bad at communicating with each other without some intermediary in the middle.
Yeah, that historical friction was mostly a language barrier. If a German bank tried to send data to an American bank, they were using totally different digital formatting.
Right, like Mac versus PC back in the day.
Basically, yeah. They needed translators,
Yep.
which meant delays and middlemen. ISO 2022 acts as a universal digital translator. It's a standardized messaging protocol that allows any modern bank on the system to instantly verify and interpret data from any other bank.
Which means the direct FaceTime call connects without any lag. And what does that mean for the merchant's bottom line?
The financial difference is staggering. That €100 transaction that was costing up to $2.50 on the card network,
Yeah.
over A2A rails, it drops to a flat 50 cents, just 0.5%.
That is massive. And the merchant doesn't have to wait 3 days to actually get their cash, right?
No, because A2A leverages instant payment rails, like SEPA Instant in Europe or FedNow in the US. So the merchant actually has the settled cash in their bank account in under 10 seconds.
10 seconds instead of 3 days.
Yeah. Same-day revenue becomes same-second revenue. Plus, they bypass one of the biggest headaches in retail tech, which is PCI compliance.
Okay, I constantly hear about PCI compliance, but what does it actually mean for a business owner in practical terms?
Think of credit card numbers as toxic radioactive material.
Okay.
If a business wants to accept and route those numbers, the payment industry forces them to build a highly regulated, incredibly expensive lead-lined vault to store and transmit them safely.
Right, a massive security headache.
Exactly. And that vault is PCI compliance.
But with A2A?
There's no card number.
Huh.
The merchant never touches the customer's sensitive financial data. They are just handing the customer a digital link to open their own bank account.
So no toxic material, no expensive vault required. As a business owner, that sounds like an absolute dream. But I have to push back here on the consumer experience.
Yeah.
Because as a buyer, tapping my saved card on my phone with Apple Pay or whatever is completely frictionless. If I'm paying bank to bank at a busy coffee shop, do I have to stand there manually typing in my bank account routing numbers while a line of angry people forms behind me?
That is the most common misconception, and honestly, if A2A required manual typing, it would fail instantly.
Oh, nobody has time for that.
Right. The user experience is completely seamless. When you trigger the payment at the register, a notification pops up on your phone, you tap it, and it automatically launches your default banking app.
So the merchant amount and all those details are already filled in.
Everything is pre-populated. The only action you take is glancing at your phone for Face ID or, resting your finger on the biometric scanner to authenticate. You tap, confirm, and the money moves.
Wait, let's step back for a second because a realization is hitting me. Moving money directly from one bank to another isn't a new concept. Wire transfers have existed since the telegraph. So why are we only doing this at a coffee shop now? Is it simply because we all finally have smartphones in our pockets?
The smartphone is a massive piece of the puzzle, but it's really only one leg of what the guide calls the why now trifecta. 3 major technological pillars had to mature and converge simultaneously to make A2A viable for everyday commerce.
Okay, let's break those down. The smartphone adoption is obvious. I mean, by 2025, over 85% of consumers have smartphones, and the vast majority are very comfortable managing their money on mobile banking apps. So what are the other 2 pillars?
Well, the foundational pillar is the instant payment infrastructure we touched on earlier.
Yeah.
Over the past decade, central banks have been quietly laying the concrete for real-time payment rails.
Like actual government-level infrastructure.
Exactly. Look at Brazil's PIX system. It only launched in 2020, and it already handles 60% of all Brazilian transactions.
Wow, 60% in just a few years.
Yeah, the adoption is wild. In the UK, Faster Payments handles 95% of transaction volume. If the underlying rails aren't instant, A2A is just too slow for a checkout counter.
Makes sense. So we have the instant rails and we have the mobile adoption. What's the third pillar? Is it security?
Yes, specifically strong customer authentication, or SCA. The banks had to heavily invest in biometric security so that your phone could act as a secure authentication token.
Which brings up a major concern for me. If the friction is that low and the money moves instantly, what happens if someone steals my phone? Can they instantly drain my checking account via an A2A transfer before I can even call to cancel my cards?
It is a totally fair question, but it's a counterintuitive truth of the technology that A2A actually obliterates traditional fraud models.
Really? How so?
Let's look at how legacy card fraud works. A card number is essentially a static master key. If a criminal steals that 16-digit string of numbers, maybe they buy it in a data breach on the dark web, they can use that master key on thousands of websites hoping it isn't detected. They don't even need your physical wallet.
Right, it's purely data theft. They just copy the number.
Exactly. But an A2A transaction doesn't use a static master key. Every single purchase generates a unique, one-time cryptographic token.
Oh, so the number changes every time.
Right. So for a criminal to steal your money, they would need your physical unlocked device plus your biometric data, your actual face or fingerprint. Because of that cryptographic proof tied to biometrics, A2A drops fraud disputes by an astonishing 95%.
Because it is mathematically provable that the actual owner of the account was holding the phone.
Yes, and that mathematical proof practically eliminates 60 to 70% of chargebacks.
You mean those I didn't make this purchase claims that constantly plague online merchants?
Exactly. The bank can unequivocally show that the biometric sensor was triggered by you.
Okay, so the technology is highly secure, it settles instantly, and it bypasses the expensive toll roads. But how does a consumer actually interact with it in the wild? I mean, if we aren't tapping a little plastic card on a dedicated piece of hardware, how are we initiating the payment?
Well, this is where A2A stops being just a cheaper alternative and becomes a fundamentally different way to conduct commerce. The Payware Guide emphasizes that legacy cards are rigid. They require dedicated hardware terminals or clunky manual entry on a website. A2A, on the other hand, is entirely context-dependent.
It's like water taking the shape of its container. Instead of forcing the buyer to walk over to a physical terminal, the payment method morphs into whatever makes the most sense for that exact moment.
Exactly that. The guide outlines an evolution of initiation methods. It starts with visual triggers. A merchant can display a dynamic QR code on a paper invoice or a tablet. You scan it with your camera, and your banking app opens.
Very straightforward. I think people are used to QR codes now. But the proximity triggers are where it starts feeling really futuristic. The guide mentions Bluetooth Low Energy, or BLE.
Yeah, this is a total game changer for environments like drive-thrus or toll booths. You pull your car into a specific proximity zone, the merchant's Bluetooth beacon pings your phone, and the payment notification pops up on your screen.
Wait, really? Just by pulling up?
Yep. You authenticate with Face ID while keeping both hands on the steering wheel. There's no leaning out the window in the rain trying to hand a plastic card to a cashier.
That is incredibly cool. And then there is the audio trigger, which sounds like absolute science fiction to me. Paying via sound waves. How does a soundbite actually trigger a secure bank transfer?
I know, it sounds crazy, but it relies on an acoustic payload. The merchant speaker system, whether that's a PA system at a stadium, A television commercial, or even the audio of this deep dive emits a specific audio signal.
Wait, like a secret code hidden in the audio?
Essentially, yes. Sometimes it's a high-frequency chirp that human ears can't even detect. Other times, the data is literally encrypted into the bass line of a song.
So my phone's microphone is acting as the payment terminal.
Your phone's microphone picks up the acoustic payload, decodes the sound wave into a secure payment link, and pops the notification right onto your screen.
That is wild.
Imagine being at a massive music festival. The band announces an exclusive t-shirt drop from the stage, they play a tone over the loudspeakers, and boom, 50,000 people instantly get a prompt to buy the shirt using their banking app without ever walking over to a merch tent.
That perfectly illustrates what you mean by context, because you can't comfortably read a 16-digit credit card number out loud to an automated WhatsApp chatbot. But a conversational SMS text that just opens your banking app, that removes all the friction.
Absolutely. It unlocks conversational commerce, media-triggered impulse buys, and completely hardware-free retail.
So if we take this ability to pay anywhere, through any medium, at a fraction of the cost, let's look at the hard numbers. What is the actual financial impact when businesses implement this shift?
The math in the Payware guide makes the business case undeniable, honestly. Take a regional grocery chain processing 80 million euros annually. On the traditional card network, they are bleeding roughly 800,000 euros a year, just in processing fees.
Almost €1 million just for the privilege of accepting their customers' money.
Exactly. But if that grocery chain integrates A2A and manages to shift just 40% of their customer volume over to the new rails, they save 160,000 euros every single year.
Wow.
That is pure bottom-line profit generated simply by routing the payment down a different digital pipe.
But the guide points out that the real superpower of A2A isn't just saving on transaction fees. The example of the SaaS software as a service business reveals a massive hidden benefit regarding churn.
Oh, yeah. Involuntary churn is the silent killer of subscription businesses.
Right.
When you run a monthly software subscription on credit cards, those physical plastic cards eventually expire, or they get lost, or the bank issues a new one. And when that happens, the monthly charge fails.
Right. The business loses that customer, not because the customer actually wanted to cancel, but because a piece of plastic hit its expiration date and they forgot to update their billing info.
Exactly. But bank accounts don't expire.
Ah, precisely the point.
By shifting their recurring subscriptions away from cards and onto direct A2A mandates, a mid-sized SaaS business doing 12 million euros a year might save 28,000 in transaction fees. But they recover an estimated 150,000 in retained revenue simply because the payments stop failing.
Okay, so the math for the merchants is bulletproof. They save money, they get cash instantly, and they retain more customers. But I have to play devil's advocate for the consumer here. Will people actually ditch their cards? I mean, I know people who treat their credit card points and frequent flyer miles like a literal religion.
Oh, I know them too.
Right. They put everything on their travel card. Why would they switch to a direct bank transfer if it doesn't give them a free flight to Hawaii?
It is the most critical hurdle for adoption, for sure. And the Payware guide is highly realistic about this. A2A is not going to completely kill the credit card. We are entering an era of coexistence.
So how does that division of labor shake out?
Well, cards will remain the dominant force for international travel, cross-border purchases, and obviously credit-based purchases.
Yeah.
If a user needs the 30-day float because they don't currently have the cash in their checking account, or they're chasing high-tier travel points, they will use a credit card.
But for the everyday purchases?
A2A is going to swallow domestic high-frequency debit transactions. Think about your morning coffee, your weekly grocery run, your gym membership. Because the merchant saves so much money on these transactions, they're going to highly incentivize consumers to switch.
Oh, so the coffee shop might offer you a free pastry or a permanent 5% discount just to set up A2A as your default.
Exactly. And once the consumer clears that initial mental hurdle and realizes it's just a quick Face ID scan, it becomes a habit.
What does the timeline for that shift actually look like?
The guide maps out a very clear adoption curve. Right now, we are in the early adopter phase. But between 2025 and 2030, as the instant rails mature globally, we will see massive mainstream growth. By the 2030 to 2035 window, we reach a new equilibrium. Cards stabilize to handle the high value and credit volume, while A2A captures 30 to 50% of the market for everyday domestic spending.
We're witnessing a structural shift in the global financial plumbing. The decades-old monopoly is breaking.
It fundamentally rewires the power dynamic between merchants, legacy banks, and the card networks.
Let's bring all of this together. For decades, we have relied on a bloated 12-step relay race that acts like a slow postal service, charging businesses massive tolls just to process digital numbers. But the convergence of instant payment infrastructure, mobile adoption, and biometric security has finally provided a viable alternative. A direct 5-step bank transfer that settles in seconds, costs a fraction of a percent, and doesn't require toxic card numbers.
And it achieves all of this while simultaneously opening up entirely new contexts for commerce. You are no longer tethered to a physical terminal. Your payment method adapts to a QR code, a proximity beacon, or even a sound wave.
Next time you tap your phone to pay for something, take a second to look past the illusion of that little beep. Think about the invisible journey your money is taking behind the scenes, and realize that very soon, a simple text message or a hidden acoustic tone might do that exact same job instantly without paying a toll to the middlemen.
The checkout experience as we know it is about to become invisible.
But before we wrap up, I want to leave you with a final thought to mull over. We talked about how A2A and credit cards will coexist, dividing the market. But if A2A successfully captures 50% of the daily domestic debit volume, it is going to starve the traditional card networks of billions and billions of dollars in interchange fees. If that well of lucrative merchant fees suddenly dries up, who is going to fund all those massive credit card rewards, points, and cashback programs that consumers have been trained to expect?
The entire points ecosystem is going to have to face a very harsh reality check.
Something to think about the next time you log in to check your frequent flyer miles. Thanks for joining us on this deep dive.
That's On the Wire, produced by Payware, the transaction resolution network for instant A2A payments. This episode was AI generated from Payware's published research and documentation. If something sparked a question, the full source material is available at payware.eu. If you work in payments at a bank, an ISV, or a merchant organization, and what you heard is relevant to what you're building, reach out. The conversation doesn't have to stop here. Subscribe to On the Wire wherever you listen to podcasts. The next episode is already waiting.